What is poppin'? It is the Slapton. I am but a lowly Slapton riding these refi waves. And this week in refi where we give you all of the refi news that is fit to go ape wild over. Of course, with me is the man with the plan, the man with the persistent tan, the man of the hour, the man with the power, the man who is so sweet that he's never sour, Sir Rez.
Hello, it's me. Also, what is that intro?
That was good, right? I'm expanding
Eh,
upon it.
like, 100 episodes in, it's just gonna be half the episode.
It already is.
Mm.
I just stay up every night trying to write down rhymes to intro you.
Nice.
You're
You'll
back
you'll
from.
have that you'll have that like losing touch with reality wall where it's just like scribbled on the wall and it wraps around your whole apartment or something.
There's a reason why I crop our videos. You'll never see the environment I live in. Rez, you're back from Bogota,
Yes.
and you told me that you caught the Bogota sleeping illness. You and everybody at Solid
Yes.
World.
Yes, the Bogota sleeping illness, which is you feel like very shit and then you sleep for 20 hours a day and then you eventually recover. That's been the experience of literally, I think, everybody that went to Bogota from Solid World.
See,
And a couple of other people, definitely, as well.
sleeping and feeling like shit is what I know is depression. But
Yeah. Hopefully not that, yeah.
we got a lot to talk about today. So without further ado, let's get into it. But we would be remiss if we didn't mention our favorite refi jobs board, refijobs.com. If you are looking to get involved in this space, the regenerative finance space, you're a job seeker, perhaps a job poster, check out refijobs.com. Curated jobs, high quality, become part of the movement, do well and good at the same time. Sir
Yeah,
Rez.
you can see Nori's hiring a bunch of people.
Nori is hiring a bunch of people after your epic takedown of their tokenomics on Twitter. Has that come to a any resolution? Has that come to anything? Have you had conversations with them? Have they said, Rez, you're a jerk?
Uh, I had a conversation with Paul. I I got told that everything will be clear in a couple of weeks, which maybe is next week. So maybe we'll get a tokenomics update
I
from
cannot
them,
wait.
and then we can have a look at it again.
I cannot wait. All right. So in terms of doing well and good at the same time, this little mag, maybe we'll call it a rag, right? This Forbes did a little piece on Web3, which in and of itself is quite fascinating to me that we would have Forbes talking about Web3. We've made it, ladies and gentlemen, if you're in the Web3 space. And they went through trends, I think it was, or like the top 5 trends. And wouldn't you know it, Rez, one of those trends was, in fact, refi. Even Forbes seems to be on
Noise.
board with this. Maybe we can get somebody from Forbes on this. What do you think this means? Does this is well? There's two ways to think of it. Is the top in, or is there more to come?
I get the impression that the top is definitely not in. I mean, we're basically approaching bottom soon, I think. So like I don't know, man. Like it doesn't feel like we're at the top. I think there's a whole way to go after getting mentioned by Forbes once. That's going to really let ReFi take off as a space. But what were the other trends in the Forbes
Well,
article?
this is what I wanted to mention. I was just looking through it, and I hadn't pre-planned this. Is one of the other trends was the metaverse, and so this does not give me confidence in Forbes' predictive
Mm,
abilities because I've been very vocal to anybody who's asked. I think the metaverse is complete non. I think we're going to be speaking about the metaverse the way that we speak about 3D printers. Do you remember when
hmm.
everyone was supposed to have a 3D printer in their house and we were all going to
Yeah,
3D print everything by now?
yeah,
And it turns
yeah.
out nobody has a 3D printer and they're only used for industrial capacity because who the heck is going to 3D print? I think that's the
Hmm.
metaverse. I think the metaverse is going to be really good for industrial, like training of police officers, training of surgeons, things like that. But the tech isn't there and no one's going to bother strapping a clunky thing on their face to be in a glitchy world and get eye strain.
Yeah, a very, very long ago, I used to play this metaverse game called Second Life for like a couple of years. And I think it still has like 50,000 concurrent players most of the time, question mark. So I think metaverses are alive and well. It's just this kind of new brand of metaverse that is supposed to take over every facet of your life. Otherwise, it's not successful, right? I mean, if we're thinking about projects that end up with huge, inflated, hard to understand valuations, reaching into the billions of dollars of market cap with barely any product, it I think it falls into a couple of categories, but how you describe this category is the everything machine. So the more scope you have, the larger your valuation, right? So it's like if you say we're a metaverse, any investor can come in there and go like, "Oh, I know exactly what this is going to, encompass in 20 years. It's gonna encompass everything. It doesn't really require a lot of imagination." I think other examples of this category would be more layer one blockchains because you go like, "Oh, this layer one blockchain, it's gonna have infinite use cases. It's gonna be better than all other layer one blockchains, and it's going to eat the world alive." Because it's going to be the database of the planet. So then, it has that mimetic ability to just burrow deep into your brain and go like, oh, think of the upside. And I think 3D printers also fall into that category of going like, well, we don't have anything right now, but imagine a world where 3D printers make everything. Like, you want furniture? We have a 3D printer that you put, I guess, stuffing into, and then you have 3D printed furniture.
You
I
want
mean,
coffee cups?
we have coffee cups. You want meat? We have 3D printed meat. We have everything, and it's all one machine in your house. It costs half of what your house costs, but you're happy because it makes everything.
You hit it. You hit it.
Yeah.
Yeah, all you have to do is make your total addressable market, your TAM, infinite by including
Hmm.
everything. And
Yeah.
even things that haven't existed yet. And so
Hmm.
then it becomes infinite. Yes, that is absolutely what we call mission creep or scope creep, and it's nonsense. And I'm so happy you brought up layer. This is supposed to be This Week in ReFi, but it's going to be basically slapped in a res, give hot takes on things that we don't like. Layer ones, the incessant drive to create the next layer one that does something marginally better than Ethereum
Hmm.
drives me out of my mind. The fact that you
Hmm.
can just hand wave the fact that Ethereum has 60% of all DeFi TVL because your product has some marginally, perhaps theoretically better mechanism is so frustrating to me. I want to take everybody who's a proponent of these things and shake them and say, you'll be lucky if you can grab 5% of TVL in DeFi. You'll be lucky if you can grab 1%. There's Ethereum. We have our layer one. We have our layer one. It's
Yeah, and
over.
and what exactly? And I think the question ends up being like, is it 10x better, or is it 20% better? And if it's 10x better, 10x better for what? Because it's probably not like 10x better for everything. It has a use case. It has this like specific area where it's now very good because you made all of the relevant trade-offs to make that thing function excellently, right? Uh, and I think there's space for that, but like I agree that there's always in my head this question of, but why does it have to be a layer one and not a layer two, for
Thank you.
example? Which is, what is the point of a layer one? The point of a layer one is essentially to be the secure clearing house for
Absolutely.
everything, and you only need one clearing house. You don't need 17 clearing houses. You need the one, and it gets better because there's more things there, right? And the more things are there, the less there's any reason to go anywhere else. So if it isn't 10x better at being like a clearinghouse, which I think is pretty challenging to do, then it's kind of this question mark of what is the thing that it's 10x better at, and how do you make that work for you? Because 20% better isn't necessarily better. If Ethereum has years of working very stably, it has this kind of understanding. People know what it is. People have built on it. There's an ecosystem of layer twos. There's a bunch of people that depend on it for security already. So why does the security part necessarily have to be something that you reinvent, right?
Completely agree. I mean, I could talk about this forever, and we should, but yeah, like there's two things that I just think get overlooked when people are spinning up layer ones. One is that idea of TVL. Like again, do not hand wave the Lindy effect of Ethereum. Like anybody can make a burger, but you're not going to eat into McDonald's market share, right? Like that's
Mm-hmm.
even easier to do than making a layer one, and you're not doing that. Anybody can make a fizzy soft drink. You're not going to eat into Coca-Cola. There's a reason for that. It's brand recognition, it's confidence, it's the Lindy effect. And then the other thing is, I don't care if in theory your protocol is going to be more secure. What we do have is in practice um, a layer one that has undergone the most sophisticated hack attempts over years and tens of thousands of hours of audits and countless hours of developer experience. And that's called Ethereum, right? So in theory, your chain might be more secure, but nothing has been battle tested to the level of Ethereum. And I'm going to make quite a claim. Nothing ever will be.
Yes.
No one will ever
Yeah.
catch up to, I shouldn't say that. In my lifetime or in the near future, nobody will ever catch up to the security audits in real time of the Ethereum layer one.
I mean, there's definitely like this perhaps unlikely doomsday scenario where Ethereum gets completely compromised, and then you do have this very open field for other blockchains to come in and go like, no, we're not getting compromised.
It'd have to be
But
catastrophic, but even then they could roll
yeah,
back.
yeah, it would have to
Yeah.
be really catastrophic, and it would also be bad for other layer ones because I think once that happens on a grand scale, uh, it's pretty bad.
Yeah.
But it kind of has happened to other layer ones, and we'll circle back to this at the end of the show
We will.
because we're talking about the very exciting blockchain hacks.
There you go. Well, there's Slapton and Rez talk about why Ethereum is the GOAT and all layer ones are garbage. Let's get into the refi portion, shall we? Refi DAO. Founders Circle Season 2 about to kick off. Applications are open. I will leave a link to this. I will leave a link to their Discord. And for those who are unfamiliar, the ReFi DAO's Founders Circle is a collection of people in the space, in the ReFi space, who gather around certain topics. In the ReFi space, it could be DMRV, as an example, and they share experiences and they troubleshoot together and they support each other. I have been involved in some of these circles. I cannot speak highly enough about them. There is no cost to join. You just have to make yourself available, make yourself humble to share information and absorb information. And they do very well in the Gitcoin rounds. So that's another incentive to join them. What do you want to say about this, Cerez?
Yes. So the worst thing about being a founder generally is loneliness. I think it's a pretty real struggle. You start working on something new and you don't necessarily have a lot of friends anymore. And social circles that connect other people going through this struggle is excellent. And also there is this feeling of directionlessness, which you might have as a new founder, of going through your sojourn through the desert and trying to find who you are and what is your product and how does that work. And I think it's very healthy to go through that process with a bunch of other people. Finally, there's the community component of cross marketing, which we saw, I think, be very successful in the recent Gitcoin round, where combined all of these projects raised a bit over $400,000 in grants. And it's grants. It's not, investments. It's free money. You get to do whatever you want with it because it's free. No strings attached. Experiment, make things happen, apply for the next Gitcoin round with all of the evidence of the cool things you made happen. And I think that's beautiful because, Gitcoin is a very beautiful thing.
Well said. Yeah. And to echo your point, one of the things that I heard from the founders in the circle, beyond the troubleshooting and the knowledge shared, they just said it was nice to be around people who are experiencing like the same thing we're experiencing.
Yeah.
Because there's like I keep making this joke. There's like 10 of people in this space. I'm not a founder, but there are 10 people in ReFi. I say that half tongue in cheek, right? So you can't talk to your buddies about it because they don't even know what you're talking about. So yeah, it's complete loneliness unless you surround yourself with people in this very niche group, and this is the niche group. These are the niche groups to join if you want someone to bounce the ideas off of that can say, yes, I know what you mean by carbon accounting, right?
Yes.
You're not crazy.
Yeah, it's like, every time, I think almost every time we've had people on this show, they've started off with going like, okay, so additionality, permanence, and leakage. And then we go like, yes, 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 we know what additionality, permanence, and leakage is. But
Yeah.
You have to get into eh, the habit of just like explaining basic things over and over again to even just like bring people up to speed on the basics of what you're working on. So it feels very refreshing to get the opportunity to at the same time meet someone new and not have to start from absolute zero in order to explain what you're doing. They'll
Yeah.
get it, and
Good
that's
point.
cool.
Yeah, there you go. So take a look at that. That's the applications are open now. Very cool stuff. Speaking of very cool stuff, Thallo and BioCarbon Registry to demonstrate world's first two-way carbon bridge secured by Chainlink. Now, it looks like this was forged or at least has been announced in Bogota. It sounds like you have had some conversation with the parties and some background on this. So, I'll give this to you. What do you want to explain about this? What do you think is important to know?
Yeah. So Fallow is a carbon marketplace style startup, and they got this fantastic partnership going with a Colombian carbon registry called BioCarbon Registry, who has already issued, I think, well over millions of tons of carbon. And on the other end, as we know, having an alternative registry which isn't Vera gold standard is a very difficult undertaking. We had a whole episode on that, folks. So, uh, I think the episode was called something tongue in cheek, like "Why Vera Can't Be Defeated,"
That's right.
or something like
Yeah,
this.
episode
So,
17, I believe. Yeah.
yes. So go check that out if you want to hear more about what registries are and why they matter. But the whole point here is registries are a very hard space to be in. And I think there are smaller registries like Biocarbon Registry who are realizing now this value that comes from having their supply tokenized and being okay with it. Because it can be a source of demand for them and a source of utility, a source of just living in people's heads because they know you now. Uh, it's not very obvious how you get the name out of an alternative carbon registry. In my head, it's like, who do you tell this to? In what context? Why? Are they
Us.
receptive to it? Yes.
Tell
Uh,
us.
yes,
Yeah.
exactly. And I think this is a fantastic opportunity to market yourself as an industry leader, being the sort of alt registry and gaining credibility actually in a completely new community who will accept you because they want to do innovative stuff and you are going to allow them to do it. And I think that's excellent. Also, as I'm reading, the credits will be made available on Polygon, which I think is great news for a bunch of reasons. Main one being that's generally where all of the carbon-based DeFi currently is located. So I'm pretty happy to see how all of this has gone. And also Chainlink's involved, which is good for them because Chainlink does a bunch of stuff in all sections of crypto. And I'm happy to see them involved here as well. I've met people that are working on getting Chainlink more into ReFi, very cool people. And all parties involved spoke with all of them briefly at this point, and nice people doing nice things. I love it.
Nice. Yeah, Chainlink is huge. For those who don't know, they're an oracle. They bring information off the chain onto a chain. That's one of the pain points of a blockchain. It's very self-contained. How do you get data on from off-chain? So they handle that. They have a very elegant way of handling that. You can definitely look into it. So all of ReFi is going to need some level of oracle if we're talking, because our space is connected to real world assets, right?
Mm-hmm.
It is a much easier to some degree to attach your blockchain to like money, because money to some degree is an abstraction. But
Mm-hmm.
but this must be accounted, like the trees as an example must be accounted for, like these things must be accounted for somehow. There needs to be some verification that they exist off the chain. So
Yeah.
cool to see that. Now one thing we were looking at is, and you can look really quick. The carbon credits are called verified carbon credits
Mm-hmm.
on the registry, and which do not confuse with VCUs, which are the Vera uh, credits,
Carbon
right?
units,
Carbon units. Yeah, yeah, yeah.
certified units,
Yep.
something. Yeah.
But
Don't remember off the top
it
of
is
my
an
head.
alternate registry, which means that you'd have to check into their methodology, and that ultimately is going to determine what value you give to these credits and what demand to some degree will be achieved from these credits, because methodologies If they're very high, then people want them, generally speaking. And if they're low, companies don't
Less
want to
people
offset.
want them.
Yeah,
Yeah.
generally speaking, of course, price also comes into that. But good to see.
Yeah.
And so they said first two-way bridge. And so the idea is you can bring these things on and off chain relative
Hmm.
at will, right? Which you can't
Yeah.
currently do with the tokenized carbon credits that I'm familiar with in ReFi. I don't know if you know of any, but I don't know of any.
No, yeah. For the audience, the difference between a one-way bridge and a two-way bridge is how the carbon credit can move through systems. So currently, in terms of things that are launched, we have Moss and we have Toucan and we have C3, I think. Is that all of them? I think that might be all
This
of
is the
them.
ones I'm familiar with, yeah.
Yeah, there are a couple of other ones that are significantly smaller or do like some niche things, but those are generally the ones we have on chain. And all of them are essentially one way. And what one way means is that you can't go up to Toucan and tell them, hey, I own some Vera certified credits that have been tokenized about a year ago. Can I bring them back into the Vera registry? To which they will tell you, haha, no. They've functionally been removed from the underlying registry. They purely exist as a blockchain object, and Vera is not accepting them back. With two-way, essentially you get the token and you can go back to the registry and say, I have this thing, please give me the underlying asset, and they'll do it. That has very fantastic effects because it also connects what is happening on the blockchain with things happening not on the blockchain. For instance, if somebody wants to pick up a huge amount of supply, they can go on chain, buy it, bring it off chain, and sell it to somebody. So there's this sort of element of being integrated with the rest of the carbon economy, which I think is really important long term because it creates a lot more use cases and it doesn't force everybody to have to learn how to open a MetaMask wallet in order to get benefits from the on-chain carbon market existing.
Yeah, good point. And then the prices also should be much more aligned because you have the opportunity to arb on and off the chain. So you
Yes.
should not see a huge price discrepancy because why would there be?
Yes.
Yeah.
Exactly, because if it's on chain, you can get it for like $2, and off chain, it's worth $10. Somebody would have cashed in the difference a long time ago at that point.
Exactly. Cool. So we'll keep you abreast of that. This is
Mm-hmm.
one of my favorite stories: the Carbon Rosetta Stone from
Yes.
Toucan. Um, Rez, you're qualified beyond what I am to discuss this. So what would you say? Well, Rosetta Stone, for those who don't know, was the had three languages, I believe: Egyptian, Greek, Phoenician. I don't remember, but it was the way that it's the way that scholars in the Western world deciphered hieroglyphics. So
Mm-hmm.
what's the reason for naming this the Rosetta Stone?
All right. So this is essentially a overview of how data is tracked about carbon credits. So in this document that Toucan very nicely released as a sort of public good is their own thinking about what sorts of data fields exist about carbon credits. What do they look like? What's inside of them? What are all of the potential things you could add about a carbon credit? And they've gone really, really deep into defining all of the interesting information that you could possibly want about a carbon credit. And then they provide some more information about how different other parties have been thinking about it. So you can scroll down, you can check out what sorts of fields they have been proposing. And the whole point here is so we would have or we would end up with this sort of unified data format of what does carbon data look like? What is that information? What field should it have? How do these map from one player to another? So we could have this translation service essentially of going like, hey, I have tokens over here. If I want to bridge them over there, I'm going to need to connect a bunch of data between two of them to figure out how to fill out the data fields for my new token issued by somebody else. And for this, the discussion about what data even exists is very important. And that is what we're working on, a sort of meta model of all of the possible data and attributes that a carbon credit can have.
Very well said. Yeah, it should be very useful. And obviously, this stuff is arcane. We were talking about niche. There's 10 of us in the space, so
Yes, 10 of us. It's fine. You don't have to be infused about it. It's like on an engineering level really relevant,
it
but
is very
you know.
relevant. And so,
Yeah.
like, if you got a VCU and it said like project region, and you're like, well, I don't know what a project region is, go to this database. They'll explain it. They'll give examples of it, and then you're all set. And that's a very simple example. There are more difficult things to grasp on an attribute of
Hmm.
a carbon credit. Cool. Very good on Toucan for doing that.
Yes.
Here's an interesting one. So we were going through our news as we do. We came across this piece, a partnership with Polygon and Senkin, and we tend not to read marketing pieces because we just don't. It's not our game, right? Like we don't want to do the marketing work of other people. If something's
Yeah.
substantive, we'll do it. But
Yeah, I mean, if you release something new very recently, we're happy to cover that.
mhm,
If it's, 2 months after the thing has happened and we're talking about it, it's probably not
it's not
part of the
news.
show.
But
Yeah, yeah.
so we weren't going to cover this, but then this part caught our fancy. So essentially, we have an independent agency called B0 that is giving
Hmm.
ratings to carbon credits on the Senkin platform. A, double A, triple A, A being the lowest level, double A being the middle level,
Such
and
a good system.
yeah, such a good system. And so we thought this was actually an interesting thing to bring up. More than anything, is what is B0 and why do we have third-party verification for carbon credits that have already been verified by a registry like Vera?
Hmm.
So what do you think this set? I mean, what is the message if we need to have a third-party verification or third-party auditing, third-party rating system on top of the registry that is issuing these carbon credits? What do you think that
It
means?
all it all comes down to this, good old saying of 1 ton of carbon credit does not equal 1 ton of carbon credit. Like all of the projects are super different. They are in different countries. They do things slightly differently. They have different ways we're doing the accounting, even if it's in the same registry. They have different arguments to why they deserve carbon credits, and because of all of this information, sometimes. You know, at least sometimes it happens that a carbon project sneaks through that maybe didn't have any additionality at all, or had like some serious quality issues. And it's pretty clear that the current status quo isn't necessarily very good at being the ultimate arbiter of quality. And because of that, we need organizations like B0, Silvera, Renoster, these kind of organizations that give a quality rating to a carbon credit once it's out, because they save a bunch of other people a lot of time by being this arbiter of quality. Because now you, as for instance a corporation that doesn't want to get into a sort of optics garbage fire, you might opt not to offset with certain kind of projects which might have very questionable quality. And then we get these organizations who give these ratings and have a system for how they talk about quality.
Yeah, so I'm just thinking of a system where you have
Hmm.
now somebody auditing B0, right? So you have an auditor of the
Oh, that
registry.
would be so cool.
We should do
I
that.
don't know if it necessarily happens right now, but yeah. So Senken uses B0 as a sort of quality rating. So you can go into Senken's marketplace where they show you all of these tokenized carbon credits, and you can then go ahead and see how good it is by using this B0 rating. You can find the kinds of carbon credits that are very good, and for the ones that have an A rating, you will know to kind of avoid those because maybe they're not the best things to pick up.
Well said. And I like the fact that their lowest grade is an A.
I love that.
So
That's so passive aggressive.
in
Yeah, that's
in education in America, at least, there's a thing called
mm,
grade inflation. So over the
mm,
last 30 years or something like that, the average grade of a student in any like public school has risen, I think, from like a B minus or a C plus to an A. Everybody A is no longer exceptional, A is standard, and it seems like they're doing that here. So blame it on
A
grade
is
inflation.
passing.
Yes, that is right.
Yeah, well, I guess you can make the argument that A is passing here as well, because a carbon credit wouldn't have been issued if it, didn't pass somebody's
That's
eyes.
right.
And I guess the logic here is it passed some standards, So it can't be that bad, can it?
To be left to the interpreter. Well,
Yeah.
you had mentioned Renoster, and
Yes.
you turned me on to them because I wasn't familiar with them, and I was, we were looking at some of their reviews. This is also a third party verification of the quality of carbon credits, and they are not
Mhm.
nearly as nice as
Yeah.
B0, which, dude, I love hot takes, and I love people who are, or organizations willing to mix it up and be brutally honest. So, Rez, do you want to explain this rating system?
Yes. So when B0 has this rating system going from A, which is very bad, to AAA, which is very good, Renoster has a different approach to this. So what they do is they say for each carbon credit, for each this unit that should represent 1 ton of carbon removed from the air or avoided from being emitted, how many tons actually does this reflect? And for a specific project, they have publicly said that this number is 0. So it's a whole Vero project, which is an afforestation project, which means people planted trees, and these very cool folks in Renoster just went ahead and said like, nah, we shouldn't have been given carbon credits at all. The additionality is 0 in our opinion, because we're planning, I think it was eucalyptus trees. Yeah, which are used in industrial pulp. It doesn't really make sense why they have carbon credits. We don't like how they've been doing carbon accounting. We don't like how they've been verified. We don't like anything about this project, and you shouldn't be buying them because it's basically worse than greenwashing, because in our opinion it's essentially giving money to a logging company without getting anything in return.
I let
Spicy
It's
people.
so spicy. And the best part is like just the optics. Like they didn't even say like, compare this to the one single A 0.00. They went to the 100th place. They
Yes.
left no doubt that there's no value in this, and they put it in nice
Hmm.
bright red. Like it
Yes,
is I love these guys. We should
I love
I
it.
want to speak with these people. I really do.
Yeah, we should get them on the
These are
show.
my
They're
people.
very nice people. Yeah, they're very cool, and we've been actually doing carbon ratings in a different organization for a while before this. But then they decided to do this because they wanted to be spicy and very in your face about carbon accounting, and
Love
I
it.
love it because I really like carbon accounting, and for the audience that hasn't noticed this yet.
Yes, and but to be fair, they're not just they're not just taking a dump on
Hmm.
everything. The 2.12 for Manoa Red Plus, so that must be.
Yeah.
So this is the thing too. Like if you're willing to say things are bad, then when you
Hmm.
say things are good, there's a level of trust built
Yes.
into that, right? And that's kind of
Yeah.
like if as a gross analogy, if a person's going around telling everybody they're beautiful, you hear them tell it to everybody, and then they tell you that
Mhm.
you're beautiful, you'll be like, yeah, but you think everyone's beautiful, right?
Yeah, it's kind of a diluted message. You kind of didn't give me any information with that.
That's right.
Versus here, they even just say, "Hey, this beautiful Red Plus project, in our opinion, is very good because their baseline, their estimate of like what would have happened if they weren't here, was actually way too optimistic about the future, and the surrounding area got messed up a lot more than they were expecting. And because of this project actually made a dent because the surrounding area got aggressively deforested."
Yeah. Good. 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 Okay, so that's our refi stuff. Now
Mm-hmm.
we're gonna get into our DeFi gets rugged section, and you brought this to our attention. Half of all
Mm-hmm.
DeFi exploits are cross-bridge hacks.
Yes.
We were having a good laugh about this. Obviously, it's not fun if you lost your money, but
Mm.
what's the deal? Why is it that what can we learn from this? What do you think is the takeaway from knowing that half of all DeFi exploits are cross-bridge hacks?
Yes. So for the audience, a bridge is the sort of thing that you can, let's say you have Ethereum. On the Ethereum mainnet, like it's the blockchain Ethereum, you're holding a bit of Ethereum, and you'd like to move it to, let's say, Polygon, which is another blockchain. A bridge is the thing that allows you to do this. Now, generally, historically speaking, the weakest link in the whole blockchain security system has been the bridges. And it tends to be because everybody builds them a bit differently. Half of the people on the list of really big exploits didn't even get their huge bridge, which is responsible for hundreds of millions of dollars. They didn't get it audited. Like, there was no third party going like, yeah, this should have hundreds of millions of dollars on it. Nothing. And what happens when a DeFi, what happens when a blockchain bridge gets exploited is, now if I had this Ethereum on the Ethereum mainnet and I put it into the bridge would essentially hold it for me, while in the background, it's issued on the other blockchain as this kind of new object. And it functions as a voucher to get your original thing back on the original blockchain. So there's a lot of tokens just hanging around on one side of a bridge. And if you figure out how to exploit it, you're going to be in the situation where you take the tokens out, but on the other side, the vouchers are still circulating, but they're basically worth nothing because you can't redeem them anymore for the underlying asset. And that gets really nasty. So bridges are built badly. Everybody builds their own bridge. If you have a layer 1 blockchain that doesn't use Solidity, doesn't use EVM, you have to build your own thing completely from scratch in order to even operate a bridge. And it's kind of just the best attack surface you could possibly imagine. It holds a lot of money. Not a lot of people apparently focus on securing these things, which is a horrible combination. And then you end up with these kind of situations where, as we've talked before about, I think, was it the Ronin bridge hack? The one where essentially there was even this kind of hack where the doors were just kind of left open at the bank, and anybody that wanted to could just come in and grab, a couple $100,000 and leave. It was really kind of the most chaotic bank run in history, where just people that shouldn't have the money just came in, took it, and left. I think if we have like any case of like why more layer 1 blockchains are problematic, I think bridges are the ultimate problematic part of the whole puzzle, because they seem to be getting exploited at a huge rate. Every new blockchain needs its own new custom bridge. And every time a bridge gets created, it holds a bunch of money, but also for some reason, nobody spends any time making sure these things are, good.
Right. So not financial advice. I'm terrified of bridges. I've never bridged large amount of money ever. Because
really?
I do not use these bridges quite frequently. So my workaround is always to use centralized exchanges as best I can. So like, as an example, if I want to get on Arbitrum, I'll take my Ethereum, I'll put it on something like Binance.us, which has a native off-ramp to Arbitrum. And so there's obviously risk involved there, but in my humble opinion, the risk of that centralized organization rugging you is far less than getting that bridge hacked, or having some exploit on a decentralized bridge. So I'm able to withdraw, like I bring Ethereum on Binance.us, and then I withdraw the Ethereum on Arbitrum into my MetaMask. There's a fee of like less than $1 or $1. And that's the way that I go. Now, I'm not avoiding KYC, obviously, that way. But yeah, I don't touch bridges unless I have to. Yeah.
Okay, so here's the fun part about it. Even if you don't directly interact with a bridge, if there is a bridge exploit, you still get fucked the same amount.
That's true. That's true. The ecosystem. Yes. I'm trying to avoid like a bad contract that's going to eat my input or something like that. You know what I mean?
Oh, yeah. Got it.
Because that happens too.
Yeah, that has happened. There's like a lot of ways crypto can go wrong. And a lot of it seems to be the bridges. So in this article, we could even see by type of exploit, we could see a beautiful chart, I believe, showing all of the bad things that have happened. And it turns out bridge attacks are by far the worst. Only second, by a long margin, is lending, which we're going to get into next.
Yes, I could not find the graphic, but it's in there somewhere. Good. All right.
It's a link to the tweet.
Gotcha.
If you scroll down, there's the tweet, and there's a pic.twitter, and then you can see the beautiful
right.
picture
there
of.
You go.
You can just what you're supposed to do when reading this thing of $2.4 billion being compromised to bridge hacks, you're supposed to look at this number and kind of hear this sort of the screams of hell behind you, in like, you know, of all of these people that have lost their money because somebody decided not to invest into security for a thing that is holding hundreds of millions of dollars in value.
Right. Yeah, it's pretty sobering that you'd be so lax with that amount of money. But hey, there we are. Now, getting into your next bit, lending. So we'll get into Mango DAO.
Ooh.
This
It's
is
been my favorite story of the last 2 weeks.
this is your favorite story. So this is all you, Rez. Tell the people about Mango DAO and how good their governance votes are.
Yes, the markets of the mango. So it's essentially a protocol that allows you to take short and long positions. So you're betting that the price is going to go up. You're betting that the price is going to go down. That's essentially the premise of what Mango Markets is. Now, somebody realized that you could take out perhaps like way too big of a position in relation to the actual underlying asset. So imagine that you have this. Imagine that you have a parking lot filled with 10 cars, and they're all the same model. They're all like exactly the same, you know, age. And you go like, okay, the total of these cars, all of these cars, if I sold all of these cars to you, Slapton, right now, it would go for like, let's say, $250,000.
I'll take
right?
it.
Yeah. So 10 cars, $250,000. But let's say every time I sell you a car, the next car becomes a bit more expensive, right? And now, let's say you wanted to bet on the value of the cars going up and down based on how many new of these same cars come into the lot or leave the lot. You know, the price is going to change. Now, it would be insane to allow you to do, let's say, $5 million of bet on this, right? Like, it would be kind of weird because you essentially could just, for this, let's say, $500,000, you could buy all of the cars from me. I would sell them to you. The price of the cars would be really high. But let's say you took this $5 million bet on the side, right? And now you earned a lot of money on that $5 million bet, my friend. But who is going to pay you out this amount of money? That's the complicated part in this equation. For Mango Markets, it was literally everybody that was had any positions open in the whole protocol. They all lost all of their collateral. All of it. It's just gone. So that's essentially the trade that happened. A certain individual, as they used their own words, made a very profitable trade of opening up both a long and short position. So they were betting on both sides. And then they manipulated the price of the Mango token, which happened to be very cheap to manipulate the price of. So they managed to pump the price from 2 cents to 92 cents with $5 million, which in the context of what happened wasn't a lot because they got to run away with, what was it, $110 million, something like this.
Yes, it was like 118, something like that. It was crazy, yeah.
Yes. And the my favorite part about this whole story was like, okay, now it's clear this Mr. Hackerman, Mr. Big Exploiter, had a lot of Mango tokens, right? Because he just exploited the protocol, so he got a bunch of stuff. And what did he do with the stuff? He opened up a governance proposal to the Mango DAO, which said, "Hey, here's the deal. I'll give you back like half of what I exploited. So like, you know, you can get money back. I'm gonna keep half, and I'll give half back. And you guys just don't go after me. Like I did this fair and square. I'm giving a bit of money back. If you guys vote yes, I'll give you this money back, but you have to promise not to go after me." The cool part about this is he owned so many Mango tokens that he voted for this proposal himself, which heavily tilted the odds in his favor of this proposal going through, because, you know, in a sort of DAO where you get governance power by holding the token, he happened to just have exploited a bunch of tokens into his own wallet, which meant he kind of is the DAO. So he decided that, hey, guys, it's fine. Don't go after me. And the vote went through. And I think he did give half of the money back. So he ended up making $50 million on a $10 million trade. And this is why he is calling this a extremely profitable trade.
Love it. So yeah, there's a couple things to be learned from this, and we're going to see this again in the next example, is the danger of allowing large trades, large directional bets on a derivative market, on a futures market, on an underlying asset that's illiquid, right?
Yes.
So if you can move a market significantly with $5 million, and that's what he was able to do, that was the reason he was able to do what he did, then you can put a directional bet on the futures market, which has no price impact on the spot market, and you can move the futures in the direction that you want and cash out, and you're taking everybody's collateral that's on the platform. So one thing you can do is just allow for a ratio of open interest to the underlying asset, and that would, at the very least, mitigate the losses, right? And that goes back to your original example. Don't allow a $5 million bet on assets worth
on a $500,000 car lot,
exactly,
or $250,000 car. Why?
Right.
At some point you need to go like, no, this bet is too big. We need to close it out. It doesn't make sense anymore. Right. I'm sorry.
If you tried this on Ethereum as an example, if you bought $5 million spot market of Ethereum, on a relatively medium-sized exchange, it's not going to move the price very much because it's very liquid. Nope. There's a lot of liquidity there. Yeah. There's a lot of, the market is deep.
Yeah, but I mean, if you sold $5 million, it would barely move the price at all. In this case, it did what? It like 50x the price or something. It's a huge amount.
Which brings us to our next example of illiquid governance tokens being used as exploits. And this one is coming from Thallo, I believe, right?
Yes, on the Thallo blockchain, there is this protocol called, I think it was Moo Markets. Was it Moo Markets? Moola Markets. Yes, sorry. It has a cow as its logo, and it's a borrowing and lending platform where you can, much like Aave, the very well-known DeFi protocol, where you can put some stuff in and borrow some other stuff in return. So they did the same thing, essentially. You can put some stuff in, you can take other stuff out in return, as long as the things that you are taking out are less valuable than the stuff you put in. This can be very useful. For instance, you own a lot of Ethereum, but you don't want to sell your Ethereum. So instead of selling your Ethereum, you put it on, let's say, Aave, and then you borrow dollars backed by this Ethereum. So now you can go in real life and spend your fancy dollars while you still have ownership over the Ethereum that you really don't want to sell. That's the fundamental system of how lending and borrowing platforms work. Now, the problem over here was, so the steps are the following. Used some dollars, I believe it was dollars originally, it was Thallo dollars. They put some Thallo dollars as collateral. They borrowed some governance tokens of this Moola Markets protocol. They now used these governance tokens as their collateral. They put it back in on the other side, going like, hey, this is also collateral. The next thing they did was they used a bunch of money to move the price of the governance token very, very, very high. And then they just essentially borrowed everything in the system all at once. Like anything that was even available to, take out of the system, they took everything out. And then they sold a bunch of tokens, and then the price went back down. But, at this point, you just essentially manipulated the market price to make it look like your collateral was really huge, took everything else out, and then just sold the tokens, and now the collateral is no more.
Right.
That's a very short description of what happened here. It all happened in, I believe, one transaction.
Real quick, just a brief point. Rez wanted to make sure that we let you know that it was not one transaction. It was actually a guy just clicking buttons He was clicking buttons as you normally would and did multiple transactions, which makes this even more legendary. Okay, just wanted to clarify that. Bye.
So it was a very fast in and out, 20-minute adventure, more like, 2 microsecond adventure. And in this very short period of time, that protocol lost all of the money it was keeping for its participants.
And what's the theme, the thread from this and the last one is allowing illiquid governance tokens to have an outsized effect on your platform. So there needs to be some limit to what can be put up as collateral or what we can bet against if the underlying asset being put up as collateral or bet against is in a liquid market. And usually there are liquid governance
Yes.
tokens.
Mm-hmm.
Because again,
Yes.
you can't inflate your price of the collateral if it's a deep market. Try doing that with Ethereum. Try moving the
Yeah.
price. It doesn't work, right?
No.
Or at a very easy workaround would be to just blacklist everything but Ethereum, Bitcoin, and stables. That would
Yeah.
be it, right? Like
Yes.
that's the ball game.
So for context, every protocol that does this kind of stuff is potentially can potentially be exploited in a very similar fashion. What keeps this from happening are these sorts of risk parameters where they go like, hey, it doesn't make sense that you're borrowing this much. The collateral is not worth that much. We don't think you should be able to take out that big of a loan with this kind of collateral. There are a bunch of people in the background trying to figure out what these numbers should be, and they stop the systems from being exploited. The second element of this is something called price oracles. Now, what is a price oracle, you might ask? A price oracle is a source of data on chain which tells you what a token is worth. So a very standard, very classic manipulation of a price oracle might be in one transaction, taking a huge flash loan. A flash loan is essentially a loan that has to be paid back in the same transaction, so it's like very niche. You borrow $100 million, let's say, and you promise to pay it back in the same transaction. So essentially, you just got it for a microsecond. You barely owned it. Now, what happens is you use all of that money to buy a bunch of, let's say, Moola markets tokens. And now suddenly the price is very, very high because you just move the price a lot. And now you do all of this crazy shit in the middle. And then at the end of the transaction, you sell all of it and you just cash in everything you got in the middle. What makes this so kind of annoying is the fact that this isn't the first time it has happened. It is not the last time it will happen. People will keep discovering this interesting thing about price oracles over and over again. Interestingly enough, it's somewhat of a solved problem in some contexts because some price oracles don't actually give you the current, like literally just now price. It might give you the average price of a few blocks ago. That makes a lot more sense because you'd actually have to have this huge buy and somebody else could react, so they could completely ruin your strategy. But because it can happen in one transaction, it's a lot safer to exploit also. So we need to keep this in mind that please, if you're designing these kind of systems, please, for the love of everything, just go through the history of all of the possible exploits that have happened to similar protocols to yours and look over it with this kind of fine-toothed comb. And, ask yourself, are you prepared for this kind of an exploit? Because if the answer is no, you're going to lose a bunch of money that you don't even own, and everybody's going to be very angry at you. And sure, you can go like, well, I wasn't the one that exploited the protocol, but let's be honest, we have a very different perception of what security means when we're talking about the blockchain, right? So, Slapton, if you didn't lock your door, let's say, with multiple locks, it would be weird if I showed up to your door and, kind of just like busted it down and took everything I wanted and told you like, haha, you didn't secure your door enough.
Right. It'd still be illegal. Yeah.
Yeah, it would still be illegal. In blockchain, if you don't put like 17 locks on your doors, you don't put bars in front of your windows, essentially the perception is everything is fair game because there's no mechanism in the middle that's going to stop you from going into that house, stealing everything, leaving, and then going like, well, that's not my problem. You didn't invest into like 15 more locks. That's your problem. If you wanted to own a TV, you should have invested in more locks.
Every TV should come with a padlock. No, it's an interesting question. It's actually something I think about quite a bit, not just in terms of blockchain, but what the responsibility is for the individual who puts him or herself into situations that are ripe for abuse, right? And so I'll give you a really simple example. Like you kind of said it. Like, what if I don't lock my door in a high crime neighborhood or just in any neighborhood, but particularly like a high crime one? And like, what reasonably can I expect from that? Or what if I went into an area that was impoverished with a nice suit and started waving cash around in the air? Now, technically, I should not be robbed. It's still immoral and illegal.
Yeah, it's still bad.
But
Nobody disagrees.
You would look at me and say you're an idiot, right?
Yeah.
And so like it's tough because then you say, are you victim shaming? It's like that's a tough one, right? And I think it applies to blockchain because, I mean, there has to be some response. Obviously the actors themselves are the ones who are the quote unquote bad guys legally, but morally, if you design a system that allows these bad guys to operate, maybe you're not legally responsible. Maybe you are. I don't know. But certainly you have some personal responsibility to make sure that you're not putting yourself and others in situations that reasonably one would expect to be abused.
Yes.
Now, to your point,
like,
yeah, go ahead.
Yeah. It's like if you're a bank, even if you wouldn't have a legal responsibility to keep your doors closed at night, I think you still have a moral obligation to keep your doors closed at night. You know what I mean?
I do.
It's like, even if we didn't have laws that said, hey, by the way, if you're holding other people's money, you're supposed to be careful.
Right. Right. Yeah, there's a layer beyond legality. It's morality and it's implied reasonable conduct. So like to your point, like if you're designing these protocols, I think you hit it. I was thinking about the same thing. It's like have some moving average, a 200-day moving average, right, for these illiquid tokens. And if the price deviates within a certain percentage of the 200-day moving average, which is less sensitive to any one movement in a short period of time, then like lock it down, right? It's like something as quote unquote as simple as that. Now, I'm not designing it. I don't know what that looks like in terms of code, but like that would be a very good risk management mechanism. If you saw Mango move 50% over its 200-day moving average in a short amount of time, the protocol should be locking down, any sort of trades.
It's like maybe withdrawals are bad right now.
Exactly.
We don't exactly know if somebody's attacking us. Like, it'll resolve in a couple of hours maybe, but we're gonna leave the door open that if somebody really wants to get rid of all of their tokens at a really amazing price right now, you can do it. Please go do it. Do it, please.
Right.
And that would ruin your strategy. Like, you couldn't do this like fancy hack if there was some time to respond from other market people going like, "Whoa, wow, I could sell a lot of dollars of Mango right now."
Yeah, that's one strategy. I know we talk about this forever, but that seems to be one strategy to eliminate these sorts of hacks on chain is to have some sort of time lock, right? Time locks are like in and of themselves. There's a 24-hour waiting period, a contestable period, like that changes everything, right? Yeah. And it's what you often see in DAO wallets also. Like even if you have a multi-sig, there's usually like a period of time before the vault opens. That's to protect from bad actors and also to protect from something negative happening even with good actor. Like it's to protect from people who shouldn't have the keys, but it's also to protect from people who do have the keys, right?
Yeah.
So time locks are good.
Well,
yeah.
Exactly. In DeFi, and I'd say in broader crypto, you should always design systems with this understanding that you shouldn't be trusting any third party too much.
Yep.
Because if you put too much trust in one person, for instance, it's not going to end well. So there needs to be checks and balances. Otherwise, bad things are going to happen.
Key person risk, right? Isn't it something like that? There's a word for it.
Yeah. So you're exposed to a bunch of risk, and there's the question of, it's who's responsible for if you go into this sort of a system and you put in a bunch of money and you lose it, right?
Right.
Also,
right.
Like the third participant in this. So we had the hacker. We had the protocol, and we have the people
the individual,
participating.
right?
Yes. And here I'd argue this is the saddest part of it because I don't think most people that use these kind of protocols necessarily even understand how they can be exploited.
Mhm.
That's not a sort of due diligence you generally do, mainly because it takes a lot of skill to do it, but also there's this sort of implication that, hey, if they have a website, the app's working, surely they know what they're doing.
Right.
And
You're right.
it's a
Yeah.
bad assumption, but in DeFi it happens a lot. We had this huge rug pull with this project called the Anubis DAO a while ago,
Yep.
which I come back to with this very hilarious quote about one investor who I think put, what was it, $10 million into this project even before it launched. And when, they ran away with the money. But then this investor was asked, hey, why did you do that? This seems like a unreasonable idea to give these people this much money. You didn't even know who they were. And his response was, well, I was seeing that dog-themed tokens in the market were doing really well at that point. So, I thought this one's also going to go up.
Right.
And it
Right. There you go.
And-
So it's the fundamental question of who bears what responsibility and to what degree. And it's an unanswerable question. We're never going to have a perfect answer. We're just going to have a bunch of imperfect answers that, based on your biases, you're going to disagree with or agree with to some degree, right?
Yeah.
So
yeah, exactly. The government feels it should be the protocol essentially who bears all of the responsibility because we're holding people's money. Crypto essentially says, haha,
Nope.
it's your problem. So we don't necessarily, that's not our problem that you put money here. And, I'm sure there's a spectrum in between, but
Yeah. Yeah.
I think every time one of these things happens, we're like, an inch closer to getting regulated.
That's right.
Heavily.
Oh, so I always say that if you want to keep doing what we're doing and we'll get regulation whether you want it or not. And by we, I mean not you and I, but everybody in this space,
Literally everybody.
Investors, influencers, founders, like keep it up and the government will have no reason and not to, and they'll actually have reason to. They'll be able to tell the public writ large, look at all the terrible things that are happening in its space. Of course they need us. So like, yeah, we're on our way. I feel, we got to get going, but I feel like what I think about Web3 is we are speed running not just economics with Web3, but we're speed running the creation of regulation laws and just civilization in general on Web3.
Yeah.
Where we start with this idea of we don't need any governance, and then we start giving reasons why we need it. Because like we're just base, vile, untrustworthy people. Like, this is why man eventually agreed to having central authority, why we voluntarily submit to it. Is because we don't trust ourselves, right? And this is what you're seeing in the space with all this stuff. So I think that this space isn't, this is an aside. I don't think we're revolutionizing anything. I think we're just relearning what we already learned at a rapid pace. That's my opinion. So I think I know where we end up. It's the TradFi world on blockchain.
Yeah, I think there's always going to be space for kind of experimentation on the margins, and it feels like we're going through this like huge social experiment of what happens when no laws, and the answer is kind of this.
This is it. And so yeah, I'm fine with it, but most people aren't. And the government certainly
Most people aren't. Like for me,
I love it.
I think I generally know what to look out for.
Yeah.
For most people putting collateral into mango markets, I don't necessarily think that's true.
Well, hey, I got rugged by Celsius, so who am I to speak? But I knew it going in. But yeah, good point. Rez, very interesting conversations. I love the fact that we get to talk about this in terms and also on top of ReFi. Any final words?
Don't get rugged.
Don't get
DYOR, and if you don't, we'll get regulation even sooner. That's about it.
That's right. And if you want regulation, go get rugged. The faster you do it, the faster we'll get it.
Yep.
All right. We'll catch you on the next one. Remember to ape responsibly. Ape responsibly. Peace, dudes and dudettes.